Hi everyone, this is Tyler from ORATS, and today I'm going to be showing you how to make smarter trades during earnings. Today we'll go over the ORATS Earn Move Report, X Earnings Implied Volatility, and Data API. Let's get started. It's commonly known that the uncertainty over direction and magnitude leads to a gradual rise in implied volatility in the weeks leading up to earnings, up until immediately after earnings when the implied volatility drops sharply back to its normal levels. As unpredictable as this might seem, there are plenty of opportunities to take advantage of these big swings in implied volatility. On my screen, I have a recent Earn Move report from the beginning of August. You can see this report on our website, and I've provided the link in the description. This report provides proprietary forecasts and other data to help you make more informed decisions during earnings season. Let's look at the straddle Earn Move column. This is the ORATS extraction of how much the options market expects the stock price to move immediately following earnings. We derive this value using option straddle prices adjusted for the expected level of the straddle after earnings using a proprietary distribution of post-earnings expected values. If this value is higher than you think, then it might be a good time to trade an iron condor, where you can profit from a smaller move than what the market is expecting. You can see the average percent move of the stock price over the last 12 quarters of earnings in the past Earn Move column. In addition to the straddle price forecast, we also calculate a very important metric called X Earnings Implied Volatility. We know that implied volatility shifts before and after earnings, but by exactly how much? Here's our answer. We know that after earnings, the volatility will fall to what we call a rational skew. Behind the scenes, this calculation is similar to the straddle price forecast, where we analyze data such as historical volatility and expected price distributions. Diving into this further, let's look at the first stock, ARCB, as an example. The weighted average of the surrounding expiration IVs is 54.9%, but when we take out the earnings effect, we get a lower value of 39.5%. This means that the implied volatility attributable to earnings for this stock is around 15% at the 30-day maturity. Here's another example using our Data API with Excel. We're looking at Disney stock, which reports earnings on August 12th. If we scroll to the end, we see three important columns related to X earnings volatility. I'm going to hide the other columns so that we can get a clearer view. This column is the smoothed at-the-money term structure implied volatility. And this column is also the smoothed at-the-money term structure implied volatility, but after taking out the earnings effect. The earn effect column subtracts the two and shows the difference. The largest earnings effect takes place right after earnings, where the largest difference between the implied volatility and the rational skew occurs. This process of extracting the earnings effect can be applied to a variety of scenarios, including comparing the implied volatility to historical volatility, or comparing the implied volatility to that of an ETF, which doesn't have its own earnings season. There's a lot you can do with the ORATS earnings reports and Data API to gain an edge during earnings. Take a look at the links in the description to learn more. Thank you for watching, and I'll see you next time.